We're going to look back at the last 10 bubbles in American history and see if any of those apply to us today. Okay, so we're going to start way back in 1790 with a gentleman named Robert Morris, who was one of the original signers of the Declaration of Independence. And I want to start off by telling you that this guy was a G. He was buying land, and I don't mean like parcels of land like we buy today. He was buying millions of acres of land from the state of New York, and then he would sell it for twice as much the following year. He was buying acreage at 13 and 15 cents an acre. That's insane. So he started doing this when no one else was really seeing the value in it, and he started making a lot of money along the way. He did this for about 10 years, but the problem is that along the way, the interest rates on the properties he was carrying rose from 3.9% to about 5.9%. All this extra payments he had to carry soon put him out of commission. He tried to raise money, but he was unsuccessful because credit was tightening everywhere, and soon he went bankrupt. The problem with that was that you didn't just lose your land, you also went to jail when you couldn't pay your bills. Luckily, we don't have to worry about that today. So what can we take away from this example? Why did that bubble burst? Well, the reason why that bubble burst was because interest rates were artificially low. When they actually started to creep up where they should have been, it was impossible for the person who had the land to keep up payments or keep passing on that land to other people. So moving into our next example, 1815 to 1819, we had a huge boom in land prices in the southern part of the United States, mainly Alabama. The reason why is because cotton prices started to get out of control. So acreage in Alabama was selling for about $35 an acre. Meanwhile, in other parts of the United States, acreage was only $1 per acre. But it didn't stop there. Soon acreage was selling for $143 an acre, which was insane. Soon after that, England caught wind of all the cotton prices that were soaring in the United States, so they ramped up their production by 78%. Before long, cotton prices plummeted, and so did real estate prices. The United States was actually issuing land to people who wanted to farm the area, and because of that, the United States had to foreclose on a lot of properties that were left abandoned because there was no reason to keep farming them, because it was costing them more to maintain the payments on the land and to work the land than it was for a bushel of cotton. So what can we take away from this example? Number one was over speculation. Speculation is when we think that prices are going to continue to go up even when we're not certain. Some people may call it greed, but we're going to see if that applies to anything that we're going to talk about in the future. And lastly, there was also an overabundance of cotton, which means that drove down the commodity prices that were fueling the craze to begin with. Sometimes external factors play a big part in what home prices and land values actually are. Our next example brings us to Chicago in the 1830s. Around that time, 1825 to be exact, the Erie Canal was constructed. This allowed the eastern part of the United States to do business with Chicago for the first time ever. Now land prices started to boom because of that fact. Soon people found out that you could deliver goods from the eastern part of the United States to St. Louis for a fraction of the price that they were delivering to New Orleans. So what happened is that Illinois started to catch wind of this, and they said, we're going to construct a new canal that's going to bring all goods from the Erie Canal into Chicago area and now into the Mississippi River. But needless to say, that never happened. But along the way, the state started to talk to the Bank of Illinois and told them to make low price loans to any speculators that want to buy land around the lake. And soon prices went crazy. To be exact, about 40,000% increase in land prices. But what happened? Sooner or later, the speculation bust. There was too much land and not enough production. The canal never came, and the Bank of Illinois went out of business. Soon land prices dropped incredibly, and everyone went belly up. So what can we learn from this example? Over speculation and easy credit. Whenever banks get involved, it never ends well, especially when they're lending at artificially low rates and they're not really checking who they're lending to. Most of the people who bought in that era really weren't qualified to do it, but because of the greed and because of the speculation, it was allowed. So let's move on to our next example. Now off to sunny Los Angeles in the 1880s. Around this time, the Santa Fe rail line was constructed, which boomed the population from 6,000 people to 50,000 people in a short amount of time. Also, migrant farmers from Mexico started to come into the area because they saw a great opportunity to start growing crops. Land prices went up by 4,000%, but the problem is that there was a lot of excess land around LA, just outside of that area. When people started to figure out that they can get the same piece of land for a fraction of the price, they soon started to buy outside of LA instead of overpaying inside of LA. Also, the population didn't rise at the rate that they were expecting it to, which ultimately crashed that economy. What can we learn from this example? Oversupply of land. Prices were exorbitantly high in Los Angeles for no reason, because just a few minutes outside of Los Angeles, you could have got the same piece of land or a better piece of land for just pennies on the dollar. So whenever you have too much supply of something, the law of supply and demand will kick in and you're gonna go back to the true price. Now, moving into the 1900s, this brings us back to Chicago and for the first time into New York City. For the first time, skyscrapers started to get erected and banks were financing them at 6% interest rates. This seemed like a great idea at first because the skyscraper technology was the cutting edge, but soon it started to overbuild because with each building you had 50 floors of either residential or commercial units. Before you knew it, you had an overabundance of property, and right around 1929, when this overabundance was apparent, we also got hit with the Great Depression. Now, most experts say that even without the Great Depression, the market would have crashed. There was way too many vacancies and banks were starting to feel the pinch. What examples can we take away from this? First of all, easy credit. We know what happens when banks are too open with their lending. And then we also had an overabundance of supply. But lastly, the thing I want to talk about most in this situation is what's called the black swan. A black swan is where something interferes in that industry that has nothing to do with that industry. As we all know, the stock market crashed in 1929, which led us into the Great Depression. This was also the start of the housing recession that we felt around the 1920s into the 1930s. Our next example takes us to the bubble that never happened. After World War II, all the soldiers came home and introduced the baby boom era. Households were exploding in size, but thankfully, housing supply was also growing. People soon started to move outside of the cities and into the suburbs for the first time, and that made it all possible because more people were owning cars. Mortgages were also introduced around this time. The FHA, Fannie Mae, and VA started to become very popular loans, but they're not the mortgages that you know today. Today you can get a loan with as little as 3% down, but back then mortgages, even FHA mortgages, were 20% down and had about 20-year amortizations. That's crazy, but it made it for a healthy market. So what can we learn from this example? Yes, we had mortgages during this time, but mortgages were very difficult to get and they required you to put a 20% down payment. That's a healthy market. We also had a lot of supply, but we also had a lot of demand. So whenever they keep up with each other, the market will stay pretty much flat. In this case, it was flat for about 20 years. So our next example brings us to California in the 1970s. What happened around this time is that Americans started to become much wealthier. So what happens when you have money? You want to move to somewhere where it's nice. The climate is perfect for anyone that wants to make it rain. Not only that, but property taxes were slashed due to a new law that was passed called Proposition 13. And lastly, we had such an undersupply because homes weren't really built at the speed in which they needed to be since the 1940s. So why is it the prices rose by 156%, only to come crashing down in the early 1990s? Number one reason is because government interfered in property taxes. When you lower property taxes, it makes the prices of the homes automatically go up. You don't believe me? Look at New York prices versus New Jersey prices. It's out of this world. And we're only talking about a few $1,000s in difference. So this is exactly what happened in California during that time. Also, we had easy credit. Remember, it was the 80s. You were getting loans left and right. That also increased the value of the homes. And lastly, we had an undersupply, but then we had quickly caught up and then surpassed the need for housing in that area. All of these were the reasons why we saw the bubble burst in the early 1990s in California. Next, we're going to talk about stagflation in the 1970s and 1980s. You might ask yourself, what is stagflation? Stagflation is rapidly rising prices with slow growth. So what that actually means to us is that we're paying more for goods that we commonly use all the time. So during the 1970s, the Federal Reserve started to print a lot of excess money into our system. So this not only made real estate prices climb, but it also made everything else go up in price, including oil. And as you know, oil is used in almost everything, so it caused prices to go up even further. So in 1980, we had inflation at 12.4%, which means that a dollar today would only be worth about 87 cents a year from now. So of course, the Federal Reserve had to step in again. So they raised interest rates to double digits, which got inflation under control, but at the same time raised interest rates anywhere between 15 to 20%. I remember people saying how bad it was, but imagine what it did to the home prices. So what caused this bubble to burst? The first reason was high inflation. Obviously, when prices go up and everything, real estate is also affected. And then we had the Federal Reserve come in and raise the interest rates where it was impossible to service that debt. You had a lot of foreclosures, and you also had home prices take a nosedive. Next, we're going to talk about the S&L crisis. No, I'm not talking about Saturday Night Live. I'm talking about the savings and loan crisis. What happened during this time is that Reagan took away a lot of the restrictions that the smaller banks called S&Ls, savings and loans, used to have, such as restrictions on LTVs and restrictions on interest rates. So what that did was it caused banks to become a lot more reckless. They started betting on risky loans such as junk bonds and commercial real estate. In 1989, there were about 1,000 closures of S&L institutions. This was a major problem because a lot of people were used to going to their local bank to get mortgages. So one of the most trusted ways in which you could get financing was now gone. So what caused this bubble to burst? First of all, it was government interference. Because President Reagan took away a lot of these restrictions, it gave the banks to basically do what they wanted. And that caused us to have too much easy credit, which ultimately led for prices to rise and then suddenly come back down. So last but not least, the 2008 housing bubble. Most of us can remember this time. It was only about 12 years ago. What happened around this time is that banks started to give out loans to people who really weren't in a position to buy a home. Everyone between loan officers, real estate agents, and Wall Street were all too blind to see the writing on the wall. Some of these people that were getting loans were foreclosing on these programs just a year afterwards, some people even on their first mortgage payment. And the reason why was because these exotic mortgage programs that existed were being sold off at such a high rate that it was too much money to pass off. Wall Street was packaging them off and selling them to mutual funds and to foreign countries in order to just turn a quick return. Because of all this greed and all the speculation, sooner or later things had to correct, and they did. In 2008, thousands of banks went underwater, most notably Lehman Brothers and Wachovia. A lot of the places that were doing these subprime loans quickly found out that this could not go on forever. What can we take away from this example? First of all, over speculation. This has almost been a common thread in every one of the examples that we talked about today. We also had too much greed. Wall Street was probably the culprit in this whole mess because they introduced a liquidity platform for banks to go out there and make these loans. And then we had easy credit. It was so easy for a person to get a loan. They could literally just have a pulse and sign their name and they can get themselves a loan. All right, so is the 2020 real estate market in a bubble? I know it's in a financial crisis. That's because the whole world is in a crisis. But are we due for a correction if there were no outside influences? We're going to find out about that right now. First question, is there an oversupply? The answer to that is actually no. There's been 10 million new households since 2012, but only about 6 million units of single-family homes built. So that basically states that there isn't enough inventory right now for families to actually purchase. So that's actually a good sign of the market, and that's the only thing that's probably been keeping us afloat until now. Question number 2, do we have easy credit? The answer to that is yes and no. So can you get a mortgage pretty easily? Yeah, you can. 3.5% down, 3%. Sometimes you can even get a grant for no money down. But does that make it easy to get a loan? Actually, not really. You still have to qualify, and they do ask you for a lot of stipulations, which make sure that you can pay back that loan. But there's still a lot of bank interference. If it wasn't for these products, homes probably would be worth a lot less money. Next, are investors getting away with easy lending? The answer to that is yes. When I started investing, it was really hard to get a hard money loan. But most recently, you even have no money down hard money loans. Obviously, this is starting to become an issue as well because investors have been driving up the prices on the wholesale market. By the time it gets to the retail user, the prices are driven up like crazy. But because there's a need for the housing, prices have continued to go up. Next question, has the Federal Reserve interfered in the market? The answer to that is yes. The Federal Reserve has been printing money for decades now, trillions of dollars, and that has caused inflation everywhere, including the housing market. But they've also had interest rates at a very, very low rate for quite some time now, and that's also caused interest rates to stay low. That means that home prices also have continued to go up, and people are paying artificially low rates for these homes. Next question, have we had over speculation? The answer to that is undoubtedly yes. Since 2008, there's been a ton of people coming out of the woodwork who want to be investors. I've seen tons of first-time investors, seasoned investors, and even people from other countries coming to invest their money here in the United States. The problem with that is that there's so much competition for a limited supply of inventory that it's caused all the prices to go through the roof. Has there been Wall Street interference? The answer to that is definitely yes. Throughout the last 10 years or so, Wall Street has created many products for hard money lenders and for investors who want to refinance their properties. As soon as the market started to dip a couple of weeks ago, Wall Street actually backed out from buying any more new mortgages. So that means that now investors are going to have to buy with their own money or find other places to get funding. That's going to make prices come down in the short term, but let's see what it does in the long run. So in conclusion, are we in a bubble? The answer to that depends on how you look at things. Yes, prices are too high right now, and the reason why they're too high is because there's been such a shortage of inventory. But now we're going to catch up because there's going to be less people in the marketplace to buy homes. So since 2008, home prices have risen by 50%, but during the same time, inflation has only gone up by 20%. That margin of 30% means that home prices must come back down. Usually over time, what happens with home prices is that they keep up with inflation, but since we're so skewed right now, sooner or later prices do have to come back for a correction. Remember, the United States was founded on capitalism and speculators. Ever since the first land deals that were carved out from New York State or from the government, people have always bought properties and prospered from it. Even if Robert Morris would have kept his property after paying too much for it back in the 1790s, he'd be a billionaire today if he would have held on to it. So if you're looking at real estate in the short term, yes, you could get hurt. Yes, you could lose money. But in the long term, we'll always be okay if we hold on to our investments. Real estate is one of the soundest investments you can make. And if you're using it to live in, then it's serving you twofold. Remember, you only lose money when you sell something at the worst possible time. If we're facing a downward economy right now, you may not want to think about doing too many fix and flips, but you may want to think about buying properties that cash flow and properties that will continue to give you a lifestyle that you're used to and accustomed to. Even when there's a downturn, people are always going to need a place to live, especially renters. So if you invest into multi-family homes or single-family homes that you can rent at affordable prices, you'll always be okay in the long run. Just make sure you don't over-leverage yourself and you don't over-speculate. And most importantly, don't try to grow too quickly. Do one at a time, do two at a time, but never get over ahead of yourself because before you know it, interest rates could rise, a black swan event can happen, and you're caught holding too much debt. So that's all we have for you today. Leave it down below in the comments and let us know, do you think we're in a bubble? Do you think the real estate market was way too high? Do you think we're going to go up, down, or sideways? Let us know in the comments down below. If you enjoyed this and you want to join our community, don't forget, hit the subscribe button, hit the notification bell, and share this with anyone who you think would benefit from it. Thank you guys for watching, and we'll see you next time.